Welcome back. You're watching Buy Now, Sell Now on ET Now, and time for the viewer queries. We have our experts today, Kunal Bothra as well as Vijay Chopra. Good morning once again, Kunal, to you, and good morning to you, Vijay. Let's get going with our queries. We already have quite a bit of them building up. The first one that I've got is from Shailaja, and she wants to know if she can buy PFC at the current price for the short term. What's your take, Kunal? Can she do this?
Avoid the stock. It's been a big underperformer. I think at current market situation, you have so many large cap names and quality stocks which are available at fair bargain for themselves. So I'll suggest to not look at PFC at current juncture because of the volatility as well as the stock price getting into a downward trend even on every kind of a minor rally for itself. So I would suggest to avoid PFC and look at large cap names, more formidable ones.
Okay, I'll come back to you for another one, Kunal. This is coming from Mr. Periyasamy, and I'm going to add a couple because I missed his query the other day. He's talking about TCS and from the Tata Group company itself, group companies rather itself. He's talking about Tata Consumer Products as well. Would you suggest a fresh entry into either one of these?
So again, depends on the beta the risk appetite of the individual, and I'm sensing that if he's a senior citizen, then I believe that it makes sense to hold on to the stocks because of their inherent low beta nature of the stocks, both TCS as well as Tata Consumers. The stocks have done exceptionally even on long-term charts. And I think looking at current market positioning, it's a good mix of stocks. But if you're looking to add some other, I would say slightly high beta Tata group of names, then I would suggest a couple of other alternatives. One would be, of course, Tata Power, which we keep on discussing regularly on the show, and the fact that the stock has come back to that good support zone, 200 to 220 range for itself. And the other is Tata Motors on the longer term charts. I think it looks exceptional to me. I have been advocating Tata Motors since the last, I think, 1.5 odd year on the channel, and I maintain that stance. And it's a good long term buy, and you should definitely look to buy the stock on dips, specifically from an idea where you're looking at it from at least a 2 to 3 year kind of a time frame.
Okay, this one is from R. Sarvanan, and he is from Chennai. He wants to know about the long-term view of on Rosari Biotech. He already has some shares which he's purchased at 1,280 rupees per share. Vijay, do you track Rosari Biotech? It's a fairly newly listed counter. I think about 1 or 2 years only it's been listed on the exchanges. How does the long-term perspective look for this particular stock?
Well, I think, Cheryl, that I've been fairly against those companies which have a high price to earning. As I can see it right now, it is around 65. Also, the golden cross, the death cross has been made on the charts right around 1300. So from there, we are quite bearish on Rosari Biotech, although it is showing some resilience today. But again, as Kunal said, that there are tons of stocks which are available, which are better and which are fundamentally stronger, which have a far low PE. I would recommend a Tata Steel, an NMDC, even a TCS, which, we are expecting a buyback around, 4,500. So there are tons of opportunities in the IT space, in the pharma space. So I would say that, exit on rallies would be the call, and better to switch into some other company because they have also corrected quite a bit. So the chances of making money is faster.
Fair enough. Vijay, I'm coming back to you. Good morning, by the way. This is a question coming from Akshit, and he's asking about Paytm. Few of these new age companies gotten battered pretty badly, right? Sign of the times, I guess. But he's wondering whether to hold for the long term. He's got it IPO priced, and as I understand it, he's gotten allotment during the IPO. What should he do?
Alex, I think we've had this discussion, and when then Paytm was trading maybe close to 1,400, and we were discussing about the downgrade certain brokerages have done. So I'm still not happy with companies which are not making money. As I said earlier, even the case of Rosari, where the price to earning is pretty high. So although there's a futuristic business which the company shows a visibility of 5 years, 10 years, but again, when we have certain companies which have a great cash flow right now, which have great financials right now, why not invest there? Why not get into a Tata Motors? Why not get into a TCS, as I said earlier, or even a Steel Authority of India, which is trading at 90 odd? So, the dividend yield is 7-8%. So why to be in such companies which have a promise in future rather than look at the present when things are available at a discount, great companies are available. So why not look into a Wipro or an HCL Tech? So these companies are great, and they are time tested. So I would recommend exit on rallies in Paytm or the new age companies, so to say. And better to be in companies where there is a strong visibility of dividends, there's a strong visibility of profitability, and be in such companies, because such shocks in the market which happened yesterday, such companies cannot sustain. So we have seen they are battered, and the chances of coming back are slow, because the earnings don't support. So be in companies which are debt free and have very, very strong earnings.
Yes, that is the sound advice coming in from Vijay, that be in sound companies. Okay, this one is from Kaji, and he wants a view on FMCG index. Kunal, he's saying that he had booked profit in Nestle and HUL. He's saying, would it be a right time to enter these counters? Do you think so?
Well, again, it'll depend largely on the larger construct of the portfolio. If he's already invested into those rate sensitives, the typical and the usual names like the banking, auto, etc., then I think parking some money into quality large cap names on the FMCG side could actually turn out to be a bet. But if you've not invested into those kind of pockets, and then you're looking at just safety just to hide from the market volatility, I don't see any reason why that these stocks can give you some great or high flying returns from a medium term to longer term perspective. These are typically low beta stocks, and they tend to move in a market which is more on the docile side for itself. But now, given the market volatility, I believe that the chances of these high beta stocks to perform could be much more higher. So depends on the construct of the portfolio. But if I have to choose, maybe one of the stocks from the two names, I would definitely go for HUL at current levels. I think that's a far more attractive stock as compared to the other peer.
Okay. By the way, people are asking where this is being viewed. This is everywhere. It's on the channel, it's on all of our social media platforms, and even on the application. This question is for you, Vijay, on the long-term basis. Finolex Cables, Sandeep is asking, he's bought at levels of 451. And I'm looking at it, it's at 424 right now, so he's not losing a lot of ground. Should he hold on for the long term? How's the fundamentals looking? And he's wondering whether to move to a peer company if you don't think Finolex is a good company to hold. Vijay, did you get my question?
I think that Finolex is a good company. It's been around for some time, and has a wonderful distribution channel as well. The brand is good. But at this point of time, if I look at the charts, so the charts don't look good. Although there's some resilience in all the stocks today after yesterday's accident. But I think that, companies which have high input costs, so most of it, they use metals, they use plastics. So the input cost is going to be humongously high, and the profitability, as I said, would be hit. So be in companies which are primarily having low input costs. So either mining companies, metal companies seemingly look good, mineral companies look good, IT companies and pharma companies look good. But again, I think that the next couple of quarters, if the crude is spiking and I'm expecting a rise in the petrol and diesel prices. So the entire logistics, that the input costs, the operational costs of all the companies are going to, go up tremendously high. So I think that, stay away for a couple of quarters from such companies. Although it's a good company, I'm reiterating that I like Finolex. But as of now, I would say that exit on rallies and get into an NMDC or a Tata Steel or a TCS. These would provide great refuge and a return as well, because they have also corrected quite significantly. So a Wipro, for instance, would be a great refuge. Even Reliance, I think that Reliance is a good company to be in. And yesterday I was listening to Mark Mobius, and they say that India's dependence on oil and gas is lesser because we have huge amounts of coal. So
Right.
even Coal India seemingly doesn't look bad.
Absolutely. That's the wise advice also coming in from Mark Movies. You can also catch all of the experts' view through the course of the day on ET Now in case you've not watched it. Moving on, we have this one coming from Sunita Rai, and she wants a long-term view on Thirumalai Chemicals. Vijay, what's your take on this one?
space for sure. And the stock has corrected. So I would say that keeping a stop loss of on 200. So the stock can be, we can have a fresh position as well. And people who are holding, keep on holding with a stop loss. So I think that if stock starts moving up, there's a good probability of reaching 300. So definitely a buy and a hold at this point of time.
Kunal, next one's for you. This is from Mr. JK Lahoti, and he's asking about Gold-IAM International. If I'm not mistaken, this is a stock that got a lot of prominence because of a marquee investor that got in. I think, if I'm not mistaken, either last year or year before that. He's sitting on 20% gains on the stock. He's wondering whether to book it out right now.
Well, frankly speaking, I don't track the stock that often. But then, as you were speaking the charts, I was just checking the charts for Goldium. I think the stock had been more, has seen quite a steep rally for itself from being closer to, I think, 75 or 80 from the pandemic lows. The stock, jumped up and I think made a high of 1100 or 1140 approximately in that kind of a time span. So I think it's been an exceptional last, 1.5 year for the stock. And like I said earlier, that possible many of these mid-cap names which have risen up, 10x and 12x kind of a mode for themselves, the correction for these stocks could be at least 40 to 50%, if not more. So I would suggest that if you are sitting on 20% odd kind of a profits, you may wait for maybe another couple of percentage points if you want to because of the market conditions. But then it's better to switch out of these names and come back to quality. I think that's where you will get a lot of stability for your portfolio from not just from a short-term view, but more from a medium-term to long-term view. So, just to add on to one very important point, that right now what the phase of the markets, what we're going through in the last 3-4 months is actually the real phase of the markets. And what had happened in the last 1 year in 2020 end and 2021 end, I think was more of an extreme kind of a scenario. So this is the real market which traders and investors, they live on for so many decades, and I think that's where you'll have to have more of a realistic expectations of returns rather than the kind of fancies which you have seen in the last 1 year where stocks have jumped up 10x and 12x. That doesn't happen every time.
Right. Kunal, this next query is coming in from Ashok, and he wants to know about Restaurant Brands Asia, Burger King as it was known as earlier. 700 shares of Restaurants Brand Asia at an average price of 149 rupees per share. He wants to hold this for the long term. But what should he do? We've seen what is happening across the board. There's been a sharp decline, and Burger King, I believe, is one particular counter, has not seen a sharp up move either. So what should Ashok do with his holding?
See, I think as far as I can see the charts for Burger King as well as such kind of QSR space, whether it's Jubilant Food or such other names, I think these stocks have gone through a sharp corrections, and the rallies have not been significant enough for these names. So that probably brings in a question mark that whether the fund or the smart money has actually moved out of this space or not. That we'll probably figure out maybe over the next 1 or 2 months. But I think a better alternative for from this space would be Devyani International. I think that's a stock which I at least in terms of technicals, I do like quite a lot. The stock has good support at this 150 odd zone for itself. So if it comes closer to that 150 odd mark, say 155, 156 kind of levels, that could be a good level where you can look to average and buy. And I think that could be a much better stock over the medium to longer term.
Next question coming in from Prakash, if I'm not mistaken. He's asking about a couple of things actually. In this volatile market, he's saying that he's sitting, Kunal, with a loss of 1 lakh in a total of 5.5 lakh capital that was deployed. Should he invest more to average at this point and buy new quality stocks? Or should he wait with the current stocks to see benefits?
See, of course, you can probably do the latter part, that you can wait on your existing stocks. Now, I'm not sure what the kind of construct of your portfolio is, and how skewed it is towards large caps, mid caps, small caps, etc. But then averagely, what I can understand is that your portfolio has taken a beating of almost 15 to 20%, which is slightly higher than the markets or the indices, which means that possibly your skew is more towards the mid cap names rather than those formidable large cap names. So what you can probably do is that I think this could be a good time where you can try and construct a portfolio in a manner in which your skew is more towards large caps. Ideally, as a proportion out of 100 rupees, for example, which you invest, 60%, approximately, give or take 5-10%, should be invested into large cap names. The remainder 20%, out of the remainder 40% on an average, 20% to 25% should go towards mid caps, and the balance could be kept towards small caps. That's how an ideal portfolio gets constructed. So if you want, these are good times where you can try and tweak your portfolios and get this adjustment right.
This one is from Prateek Krishna, and he's saying that he has TCS futures, April TCS futures at 3,765 rupees a share. He's saying that he is stuck with the loss. What should he do? Kunal, this one is for you.
Yeah, so ideally, I believe TCS can make a decent comeback, but that will depend on how the entire IT stocks, would move up. So if the IT stocks have more firepower for themselves, then possibly TCS can also be one of the stronger performers. But then the fact that you've bought at 3,700 plus levels, which is almost like a 200 rupee from current zone, makes it almost like a 5% to 7% up move for TCS. Now that could happen since you have bought April futures. I would suggest that you should hold on if possible, assuming if you have some extra capital at your hand and you would want to mitigate your risk or get some additional alpha in terms of returns, then you can look at maybe selling out of selling a 3,800 or 3,900 call for TCS if the liquidity is good enough for the April expiry. That could give you some good premium, maybe 50-70 point premium odd, and that would help you reduce the cost price of your existing holdings.
Right. Okay. Kunal, quick view on. I guess we're completely out of time. Unfortunately, I had a couple more questions that I had promised to take. But what I'll do is I'll pin these and I'll take them the first thing on Monday. Apologies. Gentlemen, thank you so much for taking the time, for answering all the questions that you did answer. We have to urgently slip into a break. There's more on the other side, so do stay tuned.